Welcome to the Be Smart podcast, how not to be an idiot with your money. Jared, you're going to have to bear with me a little today. I am a nervous wreck heading into this championship game between Florida and Houston. If I pass out, if I keel over and topple out of this chair, just feel free to continue without me. Just monologue it like the old days. I am so nervous, but obviously,
I'm pulling for Florida.
I'm super happy to make it this far, but when you get this close, it's like this does not happen very often.
I'd rather face Houston than Duke, I'll tell you that.
Did you watch the Houston Duke game Saturday?
I heard about it. I didn't see it, but I heard about it. Yeah.
It was crazy. So like Duke didn't score a field goal in the last, I think, 10 and a half minutes. And then they were up 6 points with 34 seconds to go and completely shit the bed. I mean, it was crazy. I do not know how they lost that game, but that Houston defense is scary. So we'll see tonight.
Yep.
Enough about my anxiety. How was your weekend?
Well, actually, speaking of anxiety, I had some anxiety of my own thinking about the market, kind of thinking about where the market was going to open. I'm pretty flat overall. I de-risked a lot. So actually, I don't have a lot of exposure here. So I'm kind of doing okay.
Well, that's a good segue into our market headlines this week. Our first one from the Journal: markets swing wildly after Trump sticks with tariff plan. U.S. stocks whipsawed, flipping from steep losses into the green and then falling back again early Monday. This is on the heels of Trump's Liberation Day, which we talked about last week on the pod, where U.S. stocks lost $6.6 trillion in value during a 2-day washout. Based on the surge into the green this morning, it seems as though investors are trying to time a dip here, but are they too early? And are we seeing something like a suckers rally unfolding today?
So today's Monday, and I think that this rally we're getting is a little bit premature. I think it is a little bit of a sucker's rally. I think we have one more push down to about 4,700 in the S&P, which is about another 6% from here. So, there was a headline that came out this morning that Trump was going to delay the tariffs for 90 days, and then he said it was fake news. So the market ripped to like 8% and then went back down. It is a very dangerous trading environment. Like, you have to be really, really careful about. You have to exactly know your positions. You have to know what your exposures are. You have to set stops. You have to be disciplined. Stuff is moving 5% in a minute. Like, it's insanity. So I actually, believe it or not, like I don't really thrive in these sorts of environments. I don't do well when volatility is high. I don't think anybody does. I really don't think there's any traders that thrive in these sorts of environments. So I just try to lay low until it passes. And then when it passes, I'll take some risk.
Let's talk about Jay Powell and the Fed next. Powell warns of higher prices, weaker growth after tariff plan. Powell laced his remarks Friday with an undercurrent of caution about how the central bank would be able to address any fallout. He said, quote, "We're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments," end quote. Now I'm seeing that traders have increased their expectations for the Fed to cut rates this year, including the chances of a reduction before the bank's next meeting. Swaps show a chance of almost 40% that the Fed lowers its benchmark rate 25 basis points by next week, well before its scheduled policy decision on May 7. Your thoughts on this?
I think that's about fair odds. I mean, the problem is, I think when the pandemic happened, the Fed had a much faster response than this. And this, for the tariff crash, the Fed has really had no response at all. And part of the reason is because of their flawed thinking about inflation and tariffs. They believe that tariffs cause inflation. So they don't want to cut if they believe the tariffs are going to cause inflation. So, which is totally wrong. The tariffs are deflationary, as we've said before, because of demand destruction. It's going to cause prices to go down. So the Fed should cut. They're looking at it all wrong. And honestly, I think a 40% chance of a cut by next week is about fair. I think that's about fair. I tell you what, if I'm right about the stock market and we get one more push down to 4,700, that could trigger them to cut rates. And that might be the bottom. That actually might mark the bottom. So yeah, we'll see.
Speaking a little bit more about this tariffs as a deflationary force, I've got to get your thoughts on this Bloomberg op-ed from Bill Dudley, who writes, stagflation is now America's best case scenario. Trump's tariffs risk a brutal combination of recession and inflation. As he writes, the only question now is how bad the damage will be. So I guess my question for you is, how bad realistically do you see things getting, and where do you stand on recession odds?
I think what's out there is also about fair. I think the latest is that we have like a 60% chance of a recession. Doesn't mean it's going to be long or deep. Dudley is, first of all, Dudley is liberal. He's to the left. He's been writing for Bloomberg Opinion, since I was there. So it's been at least 4 years ish since he's been writing for Bloomberg. He has a pretty long track record of being wrong about a bunch of stuff. So when he's talking about like stagflation and stuff like that, like it's absolutely not going to happen.
Do you think though that tariffs will be deflationary in the long term, but we will see like an uptick in inflation in the short term?
I've been thinking about that because of the way that the data is collected, it might seem like we have an uptick in inflation in the short term. I've actually been thinking about that. It's a very smart question.
Yeah, that's what I was thinking as well. One more stock-specific headline before we move on. Tesla shares plunge below Lutnick's never this cheap level. Tesla's stock price dropped 9.2% to around $217 a share, contradicting Commerce Secretary Howard Lutnick's prediction that it would never fall below a certain price again. So just to back up a little bit, Lutnick said during a Fox News interview on March 19th, when Tesla closed around $235, that viewers should buy the stock, saying it'll never be this cheap again. Tesla is now around $233.62, down about 2.43% today. Is Tesla on your radar as a potential buy at these prices?
Yeah. Maybe a little lower. I think Tesla, I looked at some charts today. I looked at the Tesla chart today, and it looks like it's going to bottom around the same time as the market, so about Thursday or Friday. So it's really a question of like, what do you want to buy? Do you want to buy Tesla? Do you want to buy SPY? Do you want to buy both? The answer is it doesn't really matter. You buy something, it's going to go up. Lutnick was the head of Cantor Fitzgerald. He's an old school bond broker, kind of shoots from the hip. I honestly don't think he's like I don't think he has a lot of intellectual horsepower. I don't think he's very sophisticated. I don't think he's really thought through these tariffs. I don't think anybody has. It kind of seems like Besant is not being listened to as much as Lutnick and Navarro in the White House. I think Besant probably would have preferred, like 10% tariffs across the board. But they did this crazy formula around like, how big the trade deficit was and stuff like that.
For our main topic, and I don't know if you want to dive into this because technically it is from the Daily Dirt Nap, but you did publish this about 7 years ago. Break glass in case of emergency. So I realize this is for paid subscribers, but it's been so long that maybe we can give them a peek behind the curtain.
Yep.
So number one, evaluate your current portfolio. Can you talk about the importance of cash here?
You always got to have at least 20% cash, which people think is nuts. Like if you go to Edward Jones, if you go to Merrill Lynch, they're going to take your money and you're going to be fully invested. You have to have 20% cash because first of all, it acts as a stabilizing force in your portfolio. It reduces volatility. Second of all, you get income. And third of all, it's an option to buy something cheaper in the future, right? That's why you have cash.
Number two, the crash happens. Cover shorts and go long. What is your thinking here if the market drops, say, 10 to 20% in a day?
I've done a whole bunch of thinking about this because, when the crash of 87 happened, I was 13 years old. So obviously I wasn't trading. But
I was negative too.
Yes. But I did a lot of reading about it, and I've seen charts of the intraday price action and stuff like that. I've always kind of like asked myself, like, how would I behave during an actual crash? Well, we kind of just had one, you know? Um, and the one thing to know about a crash, even what we just experienced where we were down like 11% in 2 days, um, you have to tighten up risk as quickly as you can because things move in unexpected directions, right? So like you have to ruthlessly cut positions. You have to get as flat as possible. You have to raise cash because at some point there is going to be an opportunity to put on a trade, right? And what I've actually been thinking about this particular incident is that it actually kind of rhymes with 9/11. The price action is very similar. 9/11, the market was down like 12% in a week, something like that. Then we had like a big bounce, went almost back up to the previous highs, hung around there for about 6 months, and then went into a big bear market in 2002 and 2003. I kind of think we're going to follow the same pattern, especially since this is kind of an analog to the dot-com bubble. Like what we just experienced with Nvidia and the Mag 7, like it's very much like the dot-com bubble. So the point is that, if this is an analog of September 11th, 2001, the market crashes for 5 days and then it rips, you're going to want to buy it, right? Like, and I think down 17%, if you're in the ballpark, you don't have to, I try to time things exactly, but if you're in the ballpark, you buy some stocks, I think you're going to be pretty happy. But 3 to 6 months from now, I think you're going to want to sell them.
Number 3, go shopping and buy something scary. At what point would you be looking to buy something scary? And what do you mean by scary?
On Thursday. And for me, in crashes, I like to sell puts in crashes. So, if you haven't taken the options masterclass, you should take the options masterclass. But basically, if you sell puts during a crash, vol is very high, skew is very steep. You're taking advantage of selling these very expensive options. And when the market rallies, volatility is going to get smushed and the value of those options is going to collapse, right? It's really the best way to play a crash. Now, you can also do a risk reversal. You can sell a downside put and buy an upside call. I just like to sell puts.
And then the last one, number 4, make sure you can get a hold of your broker. Pretty self-explanatory there.
Yeah, I mean, but the thing is that, if you're using an online broker like Robinhood shits the bed all the time. The market gets crazy and like Robinhood goes down, Schwab goes down, like they all go down. So that's no good. So I place trades over the phone. I have a real live broker. And, I've even told him in the past, like, I've bought some puts and I said, I am going to call you at the worst possible time when the world is blowing up and you need to give me 5 minutes of your time, right?
Yeah.
Like that's how this works. Like I've told him in advance that I'm going to do this because really when the market is in free fall, like I'm going to call. First of all, because I have crash puts, I'm going to monetize the crash puts, and then I'm going to sell more downside puts.
Let's go over to the week ahead. Aside from tariff fallout, we've got CPI on Thursday with other releases on producer prices and consumer sentiment also in focus. We missing anything here on markets? I know there's a shitload going on.
I don't think the inflation data really matters this week. People aren't focused on that at all. In fact, we got a pretty positive payroll number and like nobody cared. Like everyone's focused on the tariffs, So I think CPI and PPI mean a lot less this week.
Everyone, please like and subscribe if you're a fan of the channel. It helps us a lot. One more time, go Gators.
Go Gators.
Yep. Jared, I'll talk to you again here soon. Later.
See ya.